Hey guys, so in this video I'm covering 6 stocks for the month of February 2021. Now I recently made a video for 3 stocks for February 2021. Those are stocks that I actually am actively buying, ones that I think are on deep discount. But in this video, we're going to do things a little bit differently. I want to cover some stocks, let's split it up. We'll do 3 stocks that are kind of value growth type stocks, and then 3 stocks that are kind of more risky stocks that have massive upside potential. But what I want to make clear is that these are just stocks that I'm watching. Now, yes, I do own 4 out of 6 of these stocks, so technically I am a buyer of these stocks. However, I do look for very ideal entry points, especially for the higher risk ones. So I may not be buying exactly at this point, but I will be watching them very closely. So I think it's worth adding to a watch list at least. So I just want to make that clear. These are not buy recommendations, not telling you to go out there and spend your money on these stocks. No, do your own due diligence, make your own decisions. This is not financial advice. So this is going to be pretty interesting. I think you guys are going to enjoy the video today because there's going to be a couple new stocks I haven't talked about in depth on the channel before. And all I ask is if you enjoy this video, hit that like button, subscribe, check out the new channel as well, Positive Investing News. I leave a link description down below to every video. So you want to check that out and subscribe there as well because I make a ton of videos for that channel too. Okay, that's it. That's the intro, guys. Let's get into the good stuff here. Let's start off with our first stock, and what I'll do is I'll cover the first 3 more higher growth, less risky investments, and then we'll go into the more riskier ones. So Peloton is the first one I want to talk about here because it's caught my attention recently, and I probably will be doing a dedicated video on this stock very soon. What I love about this company is that they have a strong brand. The company is posting consistent, strong growth, and they have a very loyal customer base. These are very important aspects for a business like Peloton that is very customer focused. Now, I would venture to say that the brand that Peloton has built is getting to be on par with brands like Tesla and Apple, in the sense that people who own those products will never look at another competitor product. They are just so loyal to that brand that they believe everyone should be part of that brand. And I feel that Peloton is kind of creating that sort of audience. Now, what caught my attention with Peloton is that they recently reported their earnings, and it honestly blew me away. They reported over $1 billion in revenue for the quarter, and growth was 120% year over year. This is triple-digit growth, which is absolutely amazing. They also showed their retention rate is 92%, and this is strong and shows that they have a very loyal following. Now, many people were upset from one piece of news from this earnings, which is that they're going to be spending like $100 million or so for production because they're so far behind on delivering these bikes to customers, and they're just so backlogged because there's so much demand. Honestly, I think that's a good problem to have, and I think it's smart that they're investing in this so customers can get it quicker and newer customers don't see that, there's months and months of wait time, so they're like, I'll order it later. Think about it. If you're a customer today and you want to order a Peloton, you see it gets delivered in like a week, you're much more likely to buy it today than if it says it's delivered in like 10 weeks. And you're like, I'll just wait for that delivery time to come down, then I'll order it. So I think there's a lot of customers in that second camp just not ordering some right now. And once that production number is larger and they're able to fulfill these orders much quicker, watch this revenue growth accelerate. That is kind of my mindset here with Peloton. Now with their charts, I know some of you are going to be upset with me here for not making this video before the recent bump up of 5.5% on Friday. But guys, that's why I say join my VIP group, because I can't be creating videos 24/7. But if you're part of the VIP group, you will get access to a Discord where I'm constantly posting in there and I'm updating you guys in real time when I buy or sell stocks. Anyways, regardless, even after this 5.5% bump, I think it's nothing because I feel the stock is going to break past its previous highs of 170 in fairly short order. I can't stress this enough. Peloton is actually a very strong company. It's one that I've seen before, but I never really paid too much attention to. But the more I dig into it, the more I like this business. Okay, let's move on to our second stock here, Pepsi, which is, a no-brainer, super safe stock. These guys also reported their earnings recently, which is what's caused a recent sell-off in the stock. Now, Pepsi beat on all their metrics. They grew revenues by 8.5% year over year, and they had organic growth here of 5.7%. Now, this may seem lame, it may seem, very low compared to other higher risk, high growth companies, but you gotta remember Pepsi is not that type of a business. This stock is a dividend stock. This stock is a stable, long-term stock. It's one you want to add to your portfolio for stability and reliability. You know that, in good economies, bad economies, it's going to be doing well. And you also want to add this for the dividends. They in fact just raised their dividend by over 5% recently. So, that's a nice pay raise from a stock that you can just depend on. The charts here are pretty much picture perfect for Pepsi. They're down 10%. They're now oversold. It's testing the 100 moving average on the weekly, and this has proven to be a very strong level of support historically for this stock. In my opinion, this is a very strong buy point for Pepsi. And I would say this is kind of like a no-brainer investment. So yes, that's a boring one. It's a consumer staple. I just had to throw it in here because it's showing so much value, guys. I gotta throw this and put this on your radar at least. But I promise there's no more consumer staples like this in this video. That was the only one. VMware is the next company I want to talk to you about. And some of you may have heard this company if you work in the IT sector. You work in tech in general. You definitely heard about VMware. But you may have not known that it's actually a public company. So these guys actually do a lot of stuff in the software space. They are a profitable business and they have very strong free cash flow, which is what makes this very interesting. I think that VMware is actually a pretty overlooked stock. A lot of people have heard of this company, never really looked into it. When you look at their financials though, you're like, holy, where has this been? This thing is looking very strong. And based on that metric, and I'll show you the charts in a second, there's a big disconnect, and I think that investors are overlooking this. Now, that being said, I'll be 100% transparent here with VMware. I have a slight uneasy feeling about this one for some reason. I keep thinking it's kind of like another IBM or another like Cisco. I don't know. I know it's not. I know it's pure play software really, and they're big in cloud and SaaS and that stuff. But there's just something about this company that just screams old school to me, and that's why I haven't personally opened a position in this one. So remember, I said I own 4 out of 6 of these stocks. This is one that I actually don't own. That being said, if you don't feel the same way as me, I think this is worth looking into. Like I said, the fundamentals look very strong. And I think that the future of this business is actually very good because they are expected to grow quite nicely. The charts look very interesting. It's compressing into this very tight range. And sooner or later, we will either smash up higher or break down lower. If I relied on fundamentals, I'd say that this smashes up and runs for that $200 price once again, but it could really take a strong catalyst for this to break out. So in the meantime, I think it's worth adding to a watch list. So like I said, VMware, not one that I own, but definitely worth watching because the future of this business looks good. It's just that the charts don't really do too much, and some of you may like that because could be a very good opportunity for a quick 20, 30, 40% gain. And some of you would be like, hey, this is a boring company, I'll pass on this. No, that's fine. Okay, now that was kind of like the more stable companies, the more growth type companies, just good all-around companies. Now let's talk about some more riskier companies, and these are companies you definitely want to watch, maybe have some exposure to, but you don't want to go like all out on these companies and gamble all of your money away because there is high risk in these. They have high amounts of volatility and you could lose a good amount of money if you don't have diamond hands. So Clover is the first one we're going to talk about, Clover Health specifically, because there's a few different Clovers out there in the industry. And this is a company that got hit by a short seller report recently. Now I made a bunch of videos on this topic on the new channel. So like I said, check that out. I do cover more recent events on there. So you guys will always get up-to-date information. But my opinion here on this whole topic is that it's a short-term issue. The charts for Clover Health show that it's been pulled back quite a bit. That quick drop from $14 to $12 was because of the short seller report. And I think this will actually consolidate, and soon enough we'll see some sort of recovery here. It may take some time, maybe a few days, maybe a few weeks, but as long as the numbers they have reported are true in their financial statements, which I think they are, then this should see a nice bounce back. Typically, when a stock is in a negative spotlight, there's going to be a lot of selling pressure, a lot of negativity press. It's going to keep that stock price down. But as soon as the company proves otherwise, they get past it, they have a positive catalyst, boom, those shorts are going to have to start covering, and that leads to a short squeeze. And we all know how those things play out. Tattooed Chef is the next one on here, and it's been a little while since we chatted about this company. Now, while I do like Tattooed Chef, my number one in this sector is still Beyond Meat. No doubt about that, not even a close comparison. What I like about Tattooed though is that it kind of complements Beyond Meat. It's in a different part of the market, even though they are both kind of plant-based type companies. Tattooed Chef focuses more on the frozen section, frozen meals, whereas Beyond Meat focuses on just like burgers and sausages and that kind of stuff, right? So there may be overlap at some point if Beyond decides to get into this market, but as of right now, they have their own segments, and I think they complement each other quite well. Now the charts here look very bullish actually. It's in a consolidation phase right now, and it's holding the 50 moving average on the daily quite nicely. Valuations are still not bad. I think that this will actually be pretty good in this current environment, considering everyone's shopping at grocery stores right now. Not many people are eating out. So this is actually a perfect time for Tattooed Chef to post some strong numbers. So I think overall, Tattooed Chef, good company, still pretty small today, lots of room to grow. And I like the price that it's at today. Poshmark is our next stock, and this is an online e-commerce and social company. They kind of mix the two together, and they've built a successful business. I think it's a pretty interesting company. They've built a pretty good following here. The brand is pretty strong. I've seen tons of commercials for this as well. And it seems that the overall sentiment is very positive around this business. Now, I made a video on this recently. You may have missed it. It didn't get too many views, so go check that out. But ever since then, the stock has been moving. The charts show that this has found a bottom, and now we're ready for a move up. It's following a very similar pattern, like I discussed in that video, as to what Wish stock did. And as you know, Wish stock has pretty much boomed since that low, and Poshmark could be following in these footsteps. Now don't be surprised, the thing has already bottomed out here and it's going to start moving up to close to $100 per share once again. I would not be surprised personally. Now the reason I have this in the riskier bucket is because while it's a good business, it's proven itself really, it's still a very expensive valuation. Valuations in my opinion still do matter, at least for my investment style. So when I see a company, I look at both the valuation, I look at the charts, I look at all the other factors too. And to me, while the charts look good on this one, the valuation is up there. So, it could go either way. If the market still doesn't care about valuations, this thing could be at 100 in no time. But if somehow, next week the market wakes up and they're like, valuations do matter, I think this will actually be hit quite hard. So I wanted to put it in a more speculative bucket because there is a good chance that if things change in the marketplace, this gets hit pretty hard. So those are the 6 stocks, guys. I hope you enjoyed this video and you found a little bit of insight, a little bit of value in this. Maybe? Yeah? Well, if you did, just hit the like button down below and subscribe as well. It helps the channel tremendously. And I hope you guys enjoyed this video. But either way, enjoy your long weekend. Thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one. Peace.